All right, so we've got the highest inflation in 39 years, and that's with the PCE, that's the Fed's preferred gauge. So you want to kind of understand the macro backdrop and whether it provides headwinds or tailwinds to a particular move. We've got an oil shock, we've got rapidly rising interest rates. The Fed is no longer focused on supporting stocks, it's focused on cutting inflation. We've got supply shocks that have been turbocharged by the war. We've got a food shock, and consumption is starting to be concerned, starting to show up that consumer sentiment and consumption is starting to weaken. And then we've got some big concerns longer term that we want to be watching. We've talked about Chinese real estate crash. Now we have the yield curve inversion. We have the largest tax hike in history in a way that could be really damaging. We've got problem that we'll discuss, and we've discussed before, of the sanctions being so aggressive that they could cause dollar problems, remaining a viable reserve currency. We've got supply constraints, particularly in Russia-dominated and Ukraine-dominated commodities like natural gas, nickel, palladium, neon, required in semiconductors and grain. So we've got quite a few headwinds that you want to be sort of aware of. Interest rates have continued to rise. We had this nice breakout flag come retest, and they've gone higher, broken through the head and shoulder pattern. Really, we expect at least in this cycle to get up to this 3.1, 3.3 area and maybe stall there for a while and see whether we're going to go above it. But we've got probably a long period of higher rates unless we get to the point where something cuts off economic growth. So you can buy TBF, which is inverse bonds, and those types of things on corrections. We have an oil shock, a food shock, a Fed being record behind the rate hikes of the market and starting to raise, and supply constraints turbocharged by the war. That equals headwinds for the bull market and probably more volatility. Haven't really had all those kinds of headwinds since the 1970s. The period, I think, when if you haven't had commodities in your portfolio, you're doing very badly this year. The 60-40 is doing very badly, and the possible fallout of the war is weaker growth and higher inflation. One of the big problems we want to watch carefully is the yield curve inversion is inverted again today. Yield curve inversions usually lead to recession within 1 month to 2.5 years. It's a very long window, but the one thing that you want to understand is the effect of the yield curve, which starts cutting off lending. This is the Fed funds, and this is the market 2-year yield, and we kind of watch these. It's basically, if you watch this over many, many cycles, you get to realize that we'd be a lot better off if the market set rates instead of a committee of PhD economists. They tend to get way behind after a recession, and then they have to catch up and actually go above the market rate. And when they do that, they cut off credit so much that we get a recession. We're record behind in terms of where the market rate is and where the Fed funds rate is. That means a period of catch-up. I suspect that period of catch-up will include multiple 50 basis point rate hikes. 50 basis point rate hikes depend on the environment, how harmful they are to equity markets. But when we have a lot of other headwinds, they tend to lead to at least flat markets and problems rising and a lot of volatility. Realize too that in addition to being behind a record amount versus market rates, the Fed has just increased QE by the most in history and is talking about reversing it. That will have the same effect as rate hikes. So we have a lot of potential headwinds that we want to watch. That kind of puts limits on the potential upside of equities that we want to be aware of. These are the periods in the 1970s when we had similar headwinds and we started to get 50 basis point rate hikes. The first one was in 1973, and it led to a recession and a deep bear market. The second was in 1978, and we got very volatile but flat market environments. So just realize that these headwinds, when they come all together like this in the past, have not led to a very positive equity environment. We also have leading indicators of the economy, such as interest rates and small caps, that are starting to point to the downside. So we want to start watching economic growth and see if the deceleration of the first quarter continues and gets worse. That's where we would be worried about actual recession. The GDP now is back up to sort of in the consensus range of 1.5% for Q1, but that's way down from the earlier quarter. Now, if we don't get continued growth there, we flatten out or turn down, it's going to be more of a negative for the market. COVID seems to continue to be doing what we guessed that it would, which is we had this very big spike of the Omicron. The Omicron has much fewer symptoms, so it didn't lead to any kind of healthcare crisis. In fact, it probably allowed a bigger percentage of the population to have sort of natural antibodies to repel any next rounds. And this is looking very similar to what was kind of the beginning of the end for the Spanish influenza and a couple of other pandemics. So you want to we certainly want to be watching this, make sure the global comes down like we have in the US, but we suspect there will be future variants, but they won't be nearly as prolific, not nearly as many people catching them, and the symptoms are unlikely to get worse. So we think it's kind of the beginning of the end for COVID, and there's a decent chance later this year we can get even more normalization of the economy.
Hey, Mark, can you do me a favor? Can you just zoom in a little bit?
Yeah, I'll try to. It just takes the charts out though sometimes. Okay, so the midterm, realize also that seasonally, second year presidential term is before the midterm elections. It's normally a weak to flat period until the fourth quarter. We think it's going to be a very volatile period. Hopefully the bull remains. In terms of mortgages, realize that it's also possible that housing prices could cool. We have a record increase in mortgage rates here. Basically, for the same affordability, what you could buy, the payments that would provide for a $500,000 mortgage, today you'd have to pay $390,000. So that cuts the amount that people can bid. We still have a huge inventory problem in housing. Housing is likely to continue to go up because of that, but it's probably not going to go up at the same pace it's been going because we have this mortgage sort of headwind. The other thing, Chuck talks a lot about junk bonds. We look at junk bonds in emerging markets and in the US. Both of them are quite negative, more negative than the market overall. And in fact, the emerging market junk spreads are getting down to levels that predict recession. So really want to kind of watch and see if we can get, some continuation here by the market, whether we get junk bonds following or whether they continue to lag. The other point that we talked about in PSL and want people to be aware of is we think that there's potential for another major policy error to have been made here with the sanctions. The sanctions were relatively overzealous. In fact, they violated international law when the US seized central bank assets of Russia. And I think that we have to really watch out for that being a bridge too far. If you're any other central bank in the world and you see what just happened, you've got to look at dollar assets differently than you did before and realize that basically anytime the US wants to seize those assets, it can do so with the stroke of a pen now. I think this is what we had very overzealous sanctions in 2014, after the West-led coup of Ukraine led to civil war in Ukraine that's really been going on since, and Russia began to substantially diversify away from dollar reserves into gold and other assets. And that has led to one of the steepest declines in the dollar being reserve assets in history. If this does the same thing, we could be flirting with the key 50% level. You get below that level, the dollar as a reserve currency becomes much less viable. And if that happens, you could be seeing huge devaluation. The US dollar has been sort of pumped up by it being a petrodollar and by it being a reserve asset. If that comes unglued, that could be a real long-term disaster for the US dollar, just to realize. And the other thing to realize is now, because the US is a primary producer of oil, you're seeing things like Saudi Arabia threatening to price oil directly in yuan. And yes, the US quickly gave them some more military supplies and calmed that down, but Russia and now prices a lot of oil in rubles. China prices a lot of oil in yuan, and there's a mechanism where you can take gold, yuan, or rubles and buy without going into the dollar now in oil markets. So the petrodollar is coming unglued as well. For this to be happening and for them to press their luck on undermining the reserve currency at a time when the petrodollar is coming unglued really makes it so we have to watch this carefully, watch what percentage of reserves are in dollars, and is this starting to precipitate a further liquidation? It could be a real problem down the road. I think Chuck is going to be talking about this some too. All right, so where are we in terms of the market? I would call this a mediocre backdrop. It's volatile and could really go either way right now. We can see that what we were really talking about, we wanted our net spread index to rise above its trend line. It tried to last week and then came back down. It's still below, but it's getting very close. And so we want to watch that carefully. And it's in a very similar situation with a lot of the major internals. Major internals, a lot of them hit downtrend lines last week and have backed off. And we had this sort of pattern that came back into the range. If we can clearly rise above last week's highs and have the internals break out here, it'll be a more positive environment. Not a great one, but a more positive one. So far, the rally is very spotty in terms of the sectors and the stocks that are participating. It's mostly big caps and it's mostly commodities. It needs to spread out to small caps and mid caps more thoroughly to really be a sustainable, substantial move. We have had some signals of a rally that's catchable. We got the McClellan oscillator rising above plus 150, maybe a couple days off this latest retest. We've had a decent rally. If we can get through this recent highs and break out in some of those major internals, we'll be a little bit more positive. It would be great if we could see the McClellan oscillator rise above plus 300 or the McClellan summation index rise above plus 500 to confirm a much better backdrop. We have had this back into the range on 80% down volume that often happens at inflection points. So last week's highs are really key to watch. The thing you have to watch out for is sometimes you get breakouts in the market within the context of an intermediate term or major market top being underway and not getting a correction over signal. We didn't really have capitulation, didn't really have a clear demand response. So we haven't gotten that correction over signal. And that's often when you get situations like this where you get a breakout, but it doesn't follow through and you start to turn down sharply again. Have to be aware of that possibility. And you have to be aware also in a mediocre backdrop that you can get this return to base building mode repeatedly. Really want to watch the small caps. They were the Achilles heel of last year's sort of top. And we really want to see IWM close above 215 to suggest that we're starting to turn around. Realize that in this rally, it's been mostly defensive leading, which is not positive. Usually sustainable rallies have more offensive sectors leading.